Welcome back, everyone. Treasuries are on the move this morning as the market tries to anticipate the Fed. As a reminder, we have our own Brian Chung on the ground for that announcement at 2 p.m. today. But first, a read on what's making Treasuries so cheap. Joining us now, we've got Simeon Hyman, ProShares Global Investment Strategist. Simeon, if you were to throw your own predictions out there going into this meeting, what are you looking for?
Well, look, the 50 basis points seems quite reasonable. I think what puts that in context is the fact that a lot of the Fed's work has already been done if you look at longer term expectations. First, the 10-year break-evens, they're somewhere close to 3%. We'd like them at 2, but 3 is not that far off, considering that current inflation is running much higher than that. And second, if you look at expectations for both Fed funds and the 10-year Treasury yield, you have expectations for Fed funds at the end of next year somewhere in the very high 2s, just shy of 3, which is historically not a bad place. You should have 1% real Fed funds rate. So that's looking like perhaps something a little bit more accommodative than that, but certainly not far off. I think the one thing that's a little interesting is that expectations for the 10-year 18 months from now are sitting only at about 3%. That strikes us as a little bit low because the real return on the 10-year should be more like 2% or so. So the odds of something with a good 4 handle over the next 12 to 18 months are pretty good.
Simeon, if the Fed comes out here in their press conference today and says they do not pull off that 75 basis point rate hike off the table and the jobs numbers beat on Friday above estimates, how much further does the S&P 500 fall into correction?
Well, a couple of things here. First, there's another piece that's doing part of the Fed's job right now, which is in alignment, which if we think about, say, back to the financial crisis, we had a little bit of a mismatch of the fiscal and the monetary. But important news this morning, the Treasury sales were actually shrunk. So there's been surprising deficit reduction lately. So there's contractionary stuff going on the fiscal side. So I'm not sure this would completely, let's say, freak out markets. But the earnings season has an important tell, and I think it says a little bit of something that's been going on over the last week or so. If you looked at S&P 500 earnings snapshot so far through the earnings season last Friday close, you had something like about 13% sales growth, but only 2% earnings growth. That waved the flag of margin compression. Now, in the last couple of days, that earnings growth number has risen to about 6%. Still noting a little bit of margin compression, but not as much. And I think that's part of the relief rally. So in part, the answer to your question is, let's see what earnings show up this week. And I think that may tell us more about how the market behaves. If we see margins hold up a little bit better, that's going to be a big tell, because so far, top line has been telling us that companies at least are generating revenue and the consumers remaining pretty strong.
Is there something, Simeon, it's Julie here. Hey, is there something in the sectors of the companies that are seeing better margin resistance here versus those that are not, that tells us about the broader environment as well?
Well, it does, and I'll actually go to market cap, which also tells a little bit about sectors. So this margin compression we're seeing in the S&P 500, we're actually not seeing it all in mid caps. So far, season to date in mid caps, you have very robust top line growth of over 20% year over year, but you're so far cranking out over 30% in terms of earnings growth. So that's a sort of forgotten piece of the markets people forgot about in their portfolios and their minds. It might be a good time to rethink both. And yes, does that tell us something about where margins are coming from? Sure, you have a little bit more industrials. You have a little bit more of the cyclicals and mid caps compared to the tech-heavy S&P 500. So there is a little bit of a sector story here, absolutely.
A policy tightrope that the Fed is walking right now, for sure. And so what is the probability that you would put it at with regards to whether the Fed can continue in its policy and what they've projected thus far without tipping into a recession, mild or severe?
Well, the path to normalcy, and critically, we've got to look not just at Fed funds, but we have to look at the reduction of the balance sheet. So, getting to somewhere well past 2% on Fed funds is not particularly tight monetary policy in the context of even if we get down to 2 or 3% inflation. That's normal stuff. Again, 1% real is kind of a long-term normal, if you will. So I don't think that there's such a risk of the Fed freaking out markets from being too aggressive on the tightening side, at least based on the expectations that we all see. Even if we saw 75 basis points today, I don't think that's the that's the element that will really upset markets. The tightening piece is important. If that piece is really accelerated, then the long end could jump up a little higher. Remember, we have artificial suppression of longer term yields. We should be at 4 or 5% on that 10-year right now in the absence of quantitative easing. So I'd look for the pace of tightening to be at least as important as any surprises on the Fed funds rate itself.
Simeon, I hear what you were saying about 6% earnings growth, but just based on what the Fed is doing on rates, do you think corporate America is now prepared to go into a period of negative earnings growth, of course, including what's happening with inflation?
Well, it still seems unlikely that we're going to have an earnings recession, even putting aside the question of broader stagflation. So I do think that companies will manage to stay more or less on the positive side. But you have to watch some company-specific factors that are relevant right now. I'll give you one example, and it starts on the fixed income side and can bleed all the way into the bottom line. Folks are very enamored with floating rate debt right now because the floating rate piece keeps you whole in the face of rising interest rates. The challenge with companies with floating rate on their balance sheets is that they're on the hook for it. So your protection as an investor is coming from those companies with the floating rate obligation having to pay higher and higher coupons. The benefit for companies with fixed coupon debt is just like your mortgage becomes more trivial over time. So I think there's some, I don't want to call them idiosyncratic, but there's some things to look for, whether they're sector or capitalization, market cap size, large versus mid, whether they're cyclical, technology, but also looking into the structure of how companies are financing themselves, because it looks so far that top lines are going to hold up. But if there are elements of either your financing structure or your cost structure that put a little bit more headwinds on there can be some companies that will struggle.
Simeon Hyman, ProShares Global Investment Strategist. Always good to see you. Have a great rest of the week.
Thank you.